Good morning. Welcome to Stock Market Today for Tuesday, September 29th, 2020. This is your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the great content for this show. Also give you daily stock ideas to consider. And that hits your inbox every trading day before the market opens. So U.S. equities were sharply higher in Monday's trading. Quiet day from a volume standpoint. Imagine a lot of the desks, if you will, were empty with the Yom Kippur holiday. Value performed well with energy, financials, and industrials among the best performers, though technology also beat the tape. Treasuries were little changed. The dollar was weaker against the euro, little changed against the yen. Sterling was a notable outperformer. Gold finished up 90 basis points. WTI crude ended up 90 basis points as well. As we get to the desk this morning, futures are kind of dancing around the zero line, down about 10 basis points after Asian equities were mixed overnight. China's Shenzhen was the biggest gainer. Hong Kong did lag. European markets are mostly lower after big gains yesterday. Treasuries are slightly bid with the curve flattening. So we have some bull flattening going on here this morning. The dollar is better against the yen, but lagging euro and sterling. Gold is up 40 basis points. Crude oil is down 50. And that's the setup heading into a day where the SPY builds on a successful test of support, right? We were highlighting 325 as the level, slightly undercut it down here to 320, and then we've rallied. So a two-day rally for SPY holding where it needed to, and that's important. If you're bullish, you want to see key levels hold, right? Somewhat disheartening to see 340 lose to the downside. And then when you step up and you see the bulls toe the line at 325, that became important. So remember last Tuesday, we started saying we think it makes sense to deploy some capital, begin to deploy capital that may have built up as part of a risk management process as stocks traded lower here throughout the month of September. Well, last week we said, let's start to redeploy that. And from there, I'm incrementally bullish. And here's why. SPY held and built on it. Qs moving higher from the key 270 level, right? That was the other one that we were looking at. QQQ in the middle of the chart here, tagging 270, undercutting it briefly, but quickly snapping back and rallying yesterday. And then finally, IWM gets the message and retakes its own level. Barely, but we'll count it for now. I'm obviously going to have to watch this one, but it counts. IWM, the small caps closed at 150.02. Yesterday. So it did retake, but we got the message, and that's great. We want to see small caps moving higher with the broader tape. They don't have to outperform. We just want to see them moving higher. Now, the one knock that some folks are talking about is the fact that yesterday was a low volume session, and that's fine. It was a holiday. Many people not working. So let's just see what happens today as folks get back to work. But that's the framework. Let's hit our market in a minute now. What are we writing about today? Well, stocks move higher on a low volume session. We hit on that. Tech and discretionary remain strong relative trends. I think that's important. And more importantly, defensive sectors are lagging. And I think that that's a bullish data point overall. Look at the Utes, look at the REITs, look at the staples on a relative basis. Take any of those ETFs and plot them relative to SPY, and what you will see are downtrends. I'll show them to you later, but if you want to do the work now ahead of time, you'll see downtrends. Dollar remains the most important chart in the market. I don't care what anybody says. I have it in my note. We've touched on it here in probably 3 out of the last 4 days. So we're not going to do that again today. And as I said, futures point to a slightly lower open. From a power bar perspective, some improvement, but still very much a mixed bag. Dow up 1.5% yesterday, 5 to 7 bulls to bears. S&P 500 up 1.7%, 117 to 93 bulls to bears there. NASDAQ outperforms 25 to 9 on the ratio. Small caps outperformer on the day as well, 550 to 327 bulls to bears. Bonds slightly lower, yield slightly higher. Energy, your leading sector yesterday, up 2.39%. Even a broken clock is right twice a day, and that's my take on energy. 4 to 8 bulls to bears in the ratio. According to the Chaikin Power Bar, small cap stocks and large cap stocks are somewhat bullish. Major markets are mixed. Let's do our screen of the day. So because I was doing my sector work today, I want to always be cognizant of, number one, the relative trends. Relative trends are important, but I want to solidify those relative trends with bullish ETF ratings in our model. We use in the equity ETFs, we use these individual stock ratings as an input into the ETF's rating. So really interesting in that regard. But what I did today was I looked at the 5 sector ETFs that have bullish rating: materials, comm services, industrials, tech, discretionary. And I said, all right, let's use that as a starting universe, right? Let's use the strongest rated ETFs as a starting universe, right? Why do we want to look in energy and Utes and REITs, which are bearish and miserable? Let's look at the strongest sectors in the market. Let's identify the stocks that have a neutral rating or better. Now, remember, I'm okay with neutral as long as there's outperformance. So let's make strong relative strength and input in the screen, as well as stocks that are oversold. So starting universe of bullish ETFs, sector ETFs, rating neutral or better. Stock is currently oversold based on our overbought, oversold indicator with strong relative strength. Screenshot this if you will. Some interesting names here on the list. Avago, really good name in the semi space. Salesforce, Mark Chaikin's bullish stock of the week in our note to clients on Sunday. FedEx, just a solid trend. Freeport-McMoRan, playing on the inflation theme. McDonald's, a name that we've highlighted as bullish of late. Some really just some quality names here as potential ideas. Deere, right? That's your ag play, right? So a lot of names here to take advantage of some of the themes that we've been talking about. How about Caterpillar? I'm personally long that one. Let's take a look at the sector tracker now, movement of the major sectors over the last 5 days. And your 2 best trends are at the top of the list: discretionary and tech. Industrials also on the list. That's one of our favorite cyclical groups. REITs, comms, Utes, and staples, middle of the road. Healthcare, fins, materials, and energy at the bottom of the list, with only energy lower over the past 5 days of trading. Materials, materials are somewhat held hostage to the ebb and flow of the dollar here. There's no 2 ways about it. We liked materials, starting at the beginning of June, we started really talking about this inflation theme, and it's played out, and that largely played out as the dollar was falling. Now the dollar is stabilized and broken out of a small consolidation, so we're going to have to see how it goes. I do think there's some bifurcation within the group. The ags look good. The metals are under pressure, so that's kind of interesting. If you read my market survival guide, which is published every Tuesday, we do a deeper dive on that today. Taking a look at our industry and focus, bank services. And I'll start this off by saying I have been short the banks on and off for the past few months. No position currently. Groups underperform the S&P 500 by 19.5%. Does have a strong power bar ratio, so I guess that's something. 21-17 bulls to bears there. If you're looking for bank exposure for whatever reason, Texas Capital, PacWest, and Hancock Whitney are names that you might want to consider, but recognize the fact that they are holdings in a fund that looks like this. KBE, bearish rating, weak trend below the declining long-term trend line. Weak money flow, just underperforming since January. There has been literally no reason to own these since January. No reason to own them. Underperforming. They've had their bouts where they've tried, but they can't really build on it. They haven't been able to build on it. It's a mess. Part of it, is the yield curve, but I think part of it is technology and disintermediation. I mean, the fintech revolution is likely real. And I think the nature of finance is changing, and it's a theme that potentially has legs. There's a lot of data and information out there. I urge you to read it if you're interested in thematic investing, right? If you're interested in actually understanding what drives these trends, learning about the businesses behind them, plenty of information out there. It's a theme that I'm big on. I'll continue to be big on, more than likely, at the expense of the legacy banks. Let's take a look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. Devon up on the WPX deal, 11.11%. I think there's a potential to see a lot more M&A in the oil patch. Boeing caught an upgrade, up 6.5%. IVZ, no real news there. Gap, retail names are trading well. Gap up 5.5%. And Diamondback with energy yesterday as the leading sector. Diamondback FANG actually has a bullish rating. Was up 5.3% yesterday. Loser side of the board, West Rock, nothing company specific there. Stock's been a solid performer, down 2.3%. Lilly, some small news peripherally about one of their partners and drug trials. Nothing needle moving. Stock down 1.4%. NI. They have an investor day today. That stock was lower yesterday by 1.3%. SBAC and Alexion down small. Nothing company specific to drive trading in those names yesterday. So very much quiet news flow day. All eyes are going to be on the potential, in my mind, for further fiscal stimulus. Now, Speaker Pelosi is going to meet with Treasury Secretary Mnuchin today. The Democrats are offering up a $2.2 trillion stimulus that they will likely bring to a vote on the floor. The question is, will it get out of the floor and make it through the Senate? That's the big debate. And to me, I'm kind of framing future stimulus as a nice positive upside kicker if we get it in front of the election. But I think the base case is that it's going to continue to be pulled out. So to me, stimulus now is more likely to be a positive surprise than a negative surprise. Obviously, I could be wrong, but if I'm just framing it up in my head, that's how I'm viewing it. But let's get into the trends, especially the relative trends. Take a look at discretionary. The consumer, don't count the consumer out. And what's interesting to me is that this trend is continuing even as a lot of the earlier stimulus has rolled off. Right? The added unemployment benefits, right? By now, I'm assuming most people have spent their $1,200 checks that they received early in COVID. But discretionary is still holding up. Now, retail, I'm looking at retail at the bottom of the list here. With a topside breakout, small consolidation here, but still very much in an uptrend off the March, April lows. For the ratio itself, discretionary versus SPY, solid momentum in the upside. Look at the RSI holding above 50. So builders, retail, builder supply chain, right? So names like Lowe's, Home Depot, kind of an interesting dynamic here. Obviously, you have online retail there as well, but let me ask you this. If I'm right and stimulus is kind of the base case is now further push outs and we get an upside surprise, I have to wonder what happens to this group. Have to think it continues to work. Have to think we continue to isolate names within the space. But regardless, that's a solid trend, as is the tech trend. Right? We've talked about this one a lot. I'm not going to belabor it here. Last week, we talked about it. We said it was very much intact, 50-day, 200-day, everything's rising, RSI holding bullish ranges. Hard not to like tech. We went so far last week as to explore themes within tech. We looked at semis, right? We looked at software. So nothing changed here. I just kind of wanted to identify the leading trends on a relative basis in the market right now. But I wanted to spend more time here, which is because this is what's interesting to me. These are your defensive groups from top to bottom: utilities relative to SPY, REITs relative to SPY, staples relative to SPY. And just what I see are ratios that are trading below declining 200-day moving averages. I don't know about you, without getting caught up in the day-to-day, the back and forth, the big picture trend here is that defensives are trading lower and are in downtrends. So I view that as a bullish data point. So feel more comfortable with our call last week to begin to redeploy capital into the market. It's in 2 of my notes that I wrote last Tuesday. And I feel comfortable kind of becoming incrementally bullish here today with the key ETFs holding their key levels. So that'll wrap us up. Take us for a test drive, shakenanalytics.com/test drive. I'm back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.